We are in a banking crisis, and we don't know where it's going. When you see one cockroach, there are probably more.
I think that the financials are really at risk here, the most since 2008. So I think it's crazy that no one is talking about this.
Just 2 years after the collapse of Signature, Silicon Valley, and First Republic Bank, a new banking crisis is starting to make its way through the markets.
Except this time, it's not just the banks that are in trouble. It's the entire financial system cracking from the inside out.
After all, most people don't realize that the banking system is currently sitting on hundreds of billions of dollars worth of unrealized losses.
Regulators have just allowed them to borrow even more money to stay afloat.
And even though it looks like everything's currently fine, with the market surging higher, these losses don't just magically disappear.
That is why it is crucial to understand exactly what's going on, what this means for you, which banks are most at risk, and then most importantly, how you could put yourself in the best position possible, because there is a lot more going on than most people realize. Although, really quick, if you find this helpful, it would mean the world to me if you hit the like button or subscribed if you haven't done that already.
Yes, I really dislike asking for it, but it does help out tremendously.
All right, so on the surface, all of this starts with the original banking crisis, which I'll do my best to break down in a minute. Because as it stands right now,
This means that banks are only required to keep 10% of customer deposits accessible for withdrawal at all times. And if that sounds confusing, imagine it like this. You give me $1,000 to hold on to for safekeeping, but
Under this situation, banks hope that enough people give them $1,000 so that when the first person wants their $1,000 back in it.
The benefit here is that this allows people like you and I greater access to borrowing capital. It allows us to earn interest on our deposits. Of course, to be fair, in most cases, banks are not taking your money and lending it to banks.
But instead, they loan a small portion of that money out to other people, and then they invest the rest of it in very safe and stable assets.
This ensures that as long as those investments are held to maturity, the bank gets a guaranteed return on their capital.
For example, between 2020 and 2022, interest rates were held at 0%. This is a way for the economy to remains,
And all of that money funneled back into the banking industry. In this case, though, U.S. banks had so much money
which plummeted in value as soon as the Fed began raising interest rates.
Now, in a normal market, this wouldn't be that big of a concern because the banks still technically have your money. It's just illiquid until those loans mature. But small action. And when their customers began withdrawing their money at the exact same time, that caused the liquidity crisis, which eventually resulted in 3 banks. What does that have to do with today, you might ask? Well, just like the banks of 2023 had significant amount of money locked up in low-yield treasuries,
commercial real estate was booming because you could take a loan for 1 to 2% and go and buy a property that makes 3 to 5%.
However, now that interest rates have increased, there is a problem. Commercial real estate values are plummeting, with more,
which is the same magnitude as we saw during the 2008 financial crisis.
Well, as CNN previously explained, U.S. banks hold about $2.7 trillion in commercial real estate loans.
Now, unlike most residential real estate loans that you and I would get when going and buying a house, commercial real estate loans are only kind of like the introductory rate financing of 2006. And according to the data firm Trip,
after all, commercial real estate values are almost entirely dependent on 2 factors: how much the property makes and how high interest rates are. As an example of this, just imagine that we have a $1 million building that makes $60,000 a year, which is a 6% return.
but if interest rates spike to 6%, that building could only be worth $666,000, or a 9%.
So why is this math creating a banking panic?
Well, here's where things get very interesting.
When large investors go out and buy commercial deals, they often prefer to work with smaller regional banks because those are the companies that'll give them better deals.
Because of that relationship, they're often willing to underwrite deals a lot more often based on trust rather than just the spreadsheet. That results in more flexible financing, better terms, and the willingness to take on slightly riskier loans. A lot of riskier loans.
In fact, as you can see right here, regional banks have some of the highest exposure to commercial real estate, with in some cases half of their assets.
Whether it's commercial real estate losses, treasury losses, or just another temporary liquidity issue, the fact is banks.
Meanwhile, what do you get? A checking account that barely pays you any interest?
That's why more investment firms have started advocating for alternative investments that are not correlated with the rest of the market, like Bitcoin.
For example, with this, you get to earn up to 4% back on transportation, 3% back on dining, 2% on groceries.
Plus, Bitcoin rewards earned and held in the Gemini credit card have actually appreciated 277% on average.
This makes it easy to gain a little exposure to cryptocurrency without having to buy it or try to time the market. Plus, it comes in 5 unique stainless steel colors. You could get black, silver, rose gold, Bitcoin orange, or the brand new XRP edition.
All you have to do is swipe your card like you would normally, and that's it.
I've literally earned Bitcoin back anytime I go to the grocery store or when I fill up the car with gas. It's that simple.
And if Bitcoin isn't your thing, you can also choose from 50 different options that you could switch to at any time.
Feel free to check out the description, by the way, for more information on rates and fees and see if you're eligible with no impact to your credit score.
So if you'd like to earn cryptocurrency back instantly every time you purchase, check out the link down below in the description or sign up at Gemini.com. Again, that link is down below. Thank you so much. And now let's get back to the video. All right, so in terms of what's going on today, let's talk about the banking crisis. As it stands right now, most of the panic was due to Zions disclosing,
sparking concerns that bad loans among smaller banks could be a lot more common than we expect.
And the situation was so severe that banks had to tap into overnight liquidity for a second time in a row.
On top of that, even the investment bank Jefferies told its investors that it might experience millions of dollars of losses from its. How? How is this allowed to happen? Well, get this.
In 2008, rules were put in place that would prevent banks from making riskier loans. But banks found out that and as a result of that, this loan industry had been booming.
This resulted in the entire market beginning to sell off, bank concerns coming to the picture, and a lot of people wondering if this could help. Here's the truth. Right now, it's looking like there's a huge difference between large national banks like Wells Fargo, Bank of America, JP Morgan, and so on.
The audio features a female voice speaking confidently and professionally in a narration style. The speech is clear and articulate.
For national banks, it's become very apparent that they've been stress tested. They withstand a third.
On top of that, it's also worth mentioning that these large banks have the resources to absorb any sort of losses from within the market.
On the other hand, smaller banks do have a lot more exposure to commercial real estate, and even though some of those losses might not be the end of the world. However, in terms of whether or not these loans are anything to be concerned about, Moody's just went on record to say that the banking system and private.
Anyway, in terms of banking failures, they also said that default rates on high-yield debt this year has been relatively low, holding under 5%.
By comparison, during the 2008 financial crisis, defaults on high-yield debt were in the low double digits.
They've decided from boards I had to issue a notes to that would raise a super proposal that would reach House and favor $2 to $50.
So in terms of what I think personally, it seems like this is a slight overreaction.
And in terms of the stock market, it just seems like a lot of investors are very worried about overvaluations in the market and are really
But in terms of the banking crisis, look, I just never think it's a good idea to keep more than the FDIC insured limit of usually $250,000 at any bank.
Although, in the big picture, it's all just a good reminder why you shouldn't have all of your eggs in one basket.
It's probably a good idea to have multiple bank accounts in good standing that you could use if you absolutely need it. And at the end of the day, things could still happen.
That's why I personally just feel safer with larger banks like JP Morgan, Chase, Bank of America, Wells Fargo. Did I say?
I spread my money throughout as many different places as possible, just in case something happens to one.
Really differ. And even though banks are holding on to some rather significant losses, as interest rates come back down, these should begin to.
But then again, what do I know? I'm just a random person making videos for you on the internet, and I could be totally wrong.
So let me know your thoughts down below in the comment section. I will do my best to read and reply to as many of you as I can. Hit the like button, subscribe.
I'm Sinusoy for Nestor Mayutz. Thank you so much, and until next time.